This is a comprehensive stock due diligence report on Linde PLC, LIN, based on verifiable data up to October 2025. 1. Company Overview Metric Details. Business Model. The core business is the production, processing, storage, and distribution of industrial process and specialty gases, e.g. oxygen, nitrogen, argon, hydrogen, helium, acetylene, and the provision of high-quality engineering services. The model is highly capital-intensive but features long-term, on-site contracts with large customers, take-or-pay, providing stable, predictable cash flows and high customer retention. Industry position: global market leader. Duopoly with Air Liquide. Linde is the largest industrial gases company worldwide, resulting from the 2018 merger of Linde AG and Praxair. The market is an oligopoly characterized by high barriers to entry, capital costs, pipeline infrastructure, safety, regulatory hurdles. Competitors: Air Liquide, AI. Primary global competitor: Air Products and Chemicals, APD. Nippon Sanso Holdings, NSHD. Management team. Highly regarded for its operating discipline model, which focuses on productivity gains, cost control, and superior returns on capital, particularly since the merger. 2. Financial health. Latest TTM as of Q3 2025. Linde exhibits superior margins and cash generation, typical of a dominant, mature industrial company. Metric value, LTM Q2 2025. Commentary. Revenue, LTM, 33.7 billion, slow but stable growth. LTM growth, 1.3%, 5%. Revenue is diversified globally across manufacturing, healthcare, electronics, and energy. Net income, LTM, 7.7 billion, strong profitability, driven by operational excellence and pricing power. Gross margin, LTM, 46.5%, excellent for an industrial company, indicating strong pricing power and cost management. EBITDA margin, LTM, 39.3%, exceptional margin, reflecting the high moat, fixed cost nature of the business, high returns once plants are built. Debt to equity, DE, below 0.40, estimate, healthy leverage ratio. The company utilizes debt strategically, but cash flow coverage remains very strong. Operating cash flow, LTM, 9.9 billion, very strong cash flow generation is a hallmark of the business model. Return on capital, ROC, 25.1%, Q2 2025. Extremely high ROC demonstrates efficient capital deployment and a powerful competitive advantage. 3. Valuation metrics, as of October 9, 2025. Linde typically trades at a premium due to its stable cash flows, superior margins, and growth exposure to hydrogen and electronics. Metric value, TTM, peer median, estimate. Commentary. P/E ratio to 32.38x, lower than 3-year AVG of 34.22x, high relative to the broader materials sector, but in line or slightly elevated compared to its closest peer, Air Products, APD, which often trades in the high 20s to low 30s. PS ratio, or 6.7x, significantly higher, reflects the sector-leading margins and quality of revenue. EV/EBITDA, 18.7x, high, trades at a clear premium to the materials sector average, reflecting its low-risk business model and dominant market position. PEG ratio, NA, EPS growth estimates available. Given its PEE and expected long-term EPS growth of 8 to 10%, the PEG is likely 3.0, 4.0, suggesting a high valuation relative to near-term earnings growth. 4. Growth potential. The long-term growth story is tied to decarbonization and high-tech manufacturing. Hydrogen economy. Linde is a global leader in hydrogen production, supply, and logistics. It is positioned to be a major beneficiary of government and industrial investments in green hydrogen for fuel cells, transportation, and industrial decarbonization. Electronics. Significant demand for ultra-high purity gases is driven by the global semiconductor and flat panel display industries, e.g. memory chips, logic chips, providing a high-growth, high-margin end market. Project backlog. Linde has consistently grown its sale of gas project backlog, reported at $7.1 billion in Q2 2025, double from 4 years prior, ensuring revenue visibility for the coming years. 5. Risk factors. Macroeconomic cyclicality. While protected by long-term contracts, the merchant and packaged gas segments are sensitive to global industrial production, manufacturing, steel, chemicals. A severe global recession would negatively impact volume growth. Capital intensity. High fixed costs, energy depreciation, mean utilization rates are critical. Downtime or lower than expected demand can significantly impact profitability. Energy prices. Gas and electricity are major operating costs. While contracts often include cost pass-through provisions to customers, high volatility can impact margins in the short term. Regulatory / geopolitical risk. As a global operator, the company is exposed to trade tariffs, sanctions, and tax law changes in numerous jurisdictions. 6. Dividends and returns. Metric value, 2025. YTD. Commentary, quarterly dividend, 1.50 per share, Q3, 2025. The company has a long history of annual dividend increases, a key feature for income-focused investors. Dividend yield, TTM, MARM 1.3%. Low yield, typical of a high-growth, high-quality industrial compounder. Payout ratio, NTM, 30%, 35% estimate. Healthy and sustainable, leaving ample cash for CapEx and share buybacks. Share buybacks, aggressive and consistent share repurchase program, often exceeding 1 year per quarter, which is a major driver of EPS growth and shareholder returns. 7. Market sentiment. As of October 2025, analyst consensus, buy strong, buy average price. Target, 518.30, represents 13% upside from current price. Institutional ownership, extremely high, typically 80%, signifying a high-quality, safe haven stock favored by large index and growth-darn income funds. Insider activity, generally low selling activity, typical for a large, mature corporation. 8. Other key due diligence factors. Area assessment, October 2025. Macroeconomic impact, low cyclicality. Overall, the long-term contracts, on-site plants, shield 50% of revenue from short-term economic downturns. However, the merchant business is sensitive to manufacturing PMI and global GDP. Technical analysis. Neutral charge consolidation. The stock has been trading near its 52-week high of 487.49 as of Q3 2025. The short-term trend is neutral, with key support around $450 and resistance at $480, $490. ESG, sustainability, strong, consistently highly rated. Scored low risk by Sustainalytics, 11.95 risk rating, and received an ESG score of 79 from S&P Global, OCT 2025. Linde's core business is crucial for decarbonization, hydrogen carbon capture, giving it a strong green tailwind. Innovation in MOAT, exceptional MOAT. The competitive advantage, MOAT, is primarily derived from its massive global production infrastructure, pipelines, air separation units, high switching costs for on-site customers, and proprietary cryogenic adsorption technology. R&D intensity is moderate, focused on advanced applications and low-carbon solutions, e.g., hydrogen, CCUS. International exposure, significant, diversified. Operations are global, with major segments in the Americas, EMEA, and Asia-Pacific. This diversification mitigates single-region economic risk, but exposes the company to currency risk, FX headwinds, tailwinds. Tax and accounting. Normal. Effective tax rate has been trending upward from the merger, 2018, to the 18%, 20% range, based on Q2 2025 reported income tax, reflective of its global footprint and tax planning. Generally viewed as transparent and conservative. M&A activity, acquisitive consolidator. The entire modern company is the result of the major merger, Linde AG plus Praxair. M&A activity is now primarily focused on smaller, bolt-on acquisitions to expand geographical presence or technology applications. Supply chain. Low direct input risk. Main inputs are air, natural gas, and electricity. Risks are tied more to energy price volatility, mitigated by contracts, and the timely completion of large, complex, multi-year construction projects for on-site gas plants.